Hello and welcome back to the next episode on Carly's Trading Blueprint, the series where we go from beginner in day trading all the way up to a strategy you can actually implement on to the financial markets and preferably to NASDAQ and how we like to trade. The first thing we're going to go over is the continuation trade, then the reversal trade. That's all we're going to go over in this video to make sure you understand it. You're going to understand that it's basically internal and external liquidity, so we have gone through it. We're going to go through it again just so you completely understand it and understand the terminology we use when we're looking to trade it. We should always, with continuation trades, have a draw on liquidity on the higher time frame. In this example here, as you can see, we have this previous day high. It's not the previous day we're at, but it's a daily high we can expect price to take out. So since we have a daily high up here, that's a key draw on liquidity and a key area that price is standing out. If I stand back to my screen, as I've talked about, that wick is standing out to me, so it's a draw on liquidity. Now, we can't just enter because we're going up towards that draw on liquidity, obviously. We need to pull back into a key area. So, what do we need? In a reversal trade, we're looking to trend towards a draw on liquidity. We're looking for a little pullback into a key area, and then we're looking to go back to the draw on liquidity using the high of the move that pushed us up as the break-even level. I'm going to explain that here with this trade. So, in this trade here, as you can see, we have a move to the upside. So this is the high. You could use this low here as that pushed us to the upside, but ideally you want to use this low here because that is the full range, okay? That is where price has done the big move from these lows down here all the way up towards this high here. That's the start of the move. Where would we look for price to pull back into a key area? Obviously the 0.5 of the range, as you can see right here, which also lines up with a fair value gap as well. With the middle of this fair value gap right here, they're nearly the exact same line, as you can see. So this is a key area we can look for price to bounce off and start pushing back to the upside. Before I even look at this trade, as I talked about, this would be our TP level because this is our draw on liquidity. This would be the high that we'd be looking to go break even at if we could get some sort of setup back to the upside. Now, let's let price action play out and see what happens. So, price obviously pushes higher, so we have to extend our line to the high because we're extending the range, and now our break even goes up to this line right here, as you can see. So now the move up and the 50% has come up a little bit because we're not at this wick anymore. The range got extended by this candle pushing up, and then we started to come down. So now this will be our new break-even line and start of our range. So we put the high on, obviously where it was, and then the zero on the low of the move. Again, it's not lined up with 50% anymore, but in the general area, it's right just above the 50% of this fair value gap. So that's the key area we're obviously looking for price to tap into. As you can see, price taps into it right there, and we get a very nice reaction back to the upside. When I draw out my fair value gap here, as you can see, now price has obviously tapped in that gap and started pushing back to the upside. We have tapped 50% of the range. So what are we looking for? That continuation back to the draws on liquidity to the upside from this area. How are we going to be able to determine that we can enter this position when we get an inverse with momentum above this high here? As you can see, we're looking for momentum above the high. We're not getting it yet, and there we go with this candle here. As you can see, we end up getting momentum to the upside. This candle flips bearish, taps into this order block, as you can see. So we've tapped with that low into this order block right here. As we've talked about order blocks, we can use them as stop loss placement, and lows inside them we can use as protected lows. As you can see, price inverses with momentum to the upside. It did take a few candles, but because we hit 50% of range, we've tapped into fair value gap, we've inversed to the upside, we've tapped in the order block. I'm overall bullish to the draw on liquidity. This is still a good position to take. I put my stops at this wick low here. Go and break even at 0.74 or at this high here. And then you can target the external draw on liquidity for just about 1.1 hour in this example right here. And when you let price action play out, it should push on to the draws on liquidity. As you can see, price ended up sweeping the high right here. We go break even. It comes back, doesn't take us out, ends up respecting this 15-minute gap, pushing back to the upside and taking TP on this position. And as you can see, price gets stuck at this level. We don't end up moving any higher. That is exactly a continuation trade. We're looking for price to come into the internal draws on liquidity and then push to the external. We obviously talked about that in one of our previous videos, and this is another example with the actual terminology we're going to use: continuation and reversal trades. This is a continuation trade. The key with continuation trades is you want it to come back into a key area. You don't want to just go up a little bit. You want to pull back into hopefully 50% range or into a key area like a 15-minute fair value gap, somewhere with SMT, into one of the key areas we use in our trading. Now for the reversal trade, the second type of trade we're going to take. Obviously we need a sweep into a key area. We did talk about this in the liquidity part 2 video. It's going to look very similar, this setup, but the point of how we trade is every setup's going to look similar. That is literally the point of having a system, of having a strategy. All your trades are going to look similar, from the execution to where your stop loss is to your break even. That is how you stay profitable, keeping the variables the exact same. In this example here, we come down and sweep a key external low. So at the bottom of the range we talked about, which is London low. So we'll mark that as London low. As you can see right there, we sweep out London low and start to get a reaction. Now, do we have draws on liquidity to the upside that we can look to target if price wants to show us it's bullish? Yes, we have London high right here. That can be a draw on liquidity. We have all these other highs here, swing highs, that we can target as well. And then when it comes to in the range, so not London high, we can use these draws on liquidity for a lower RR move in this example. As you can see, price comes down, takes out the low. What do we have on the way up? Well, I'm seeing we have an unfilled fair value gap right here. As you can see, so we have an, when I mark that out, I'll use this line right here. As you can see, when I put that line out, we have a unfilled fair value gap. So I'm going to mark out unfilled fair value gap. So we have that to the upside. That's a draw on liquidity for us, or it could be a break-even level. What else am I seeing? Well, we have this fair value gap right here, unfilled as well, but we'll need that to get inverse to even consider taking a position. We've also formed a little order block right here, as you can see. We have an order block right there formed after the sweep as well. So these are all areas we're marking out and use them for reversal positions. Reversal positions means we sweep the external and we want to come internal. That is literally, as we talked about in liquidity part 2, we're literally going over the same thing, but it's so important because they're the only two types of setups that we're looking to take. We're either pushing towards a draw on liquidity, or we're going away from a draw on liquidity back into the range to other draws. In this example here, as you can see, we get an inverse with very nice momentum. That will be your entry, stops under the order block here, and you can target these highs here or even higher, London high, or you can trail to 1 hour at least, because that's the minimum we're allowed taking our positions. So when we tend to get to 1 hour here, I will trail my position, looking for at least these highs to go, and maybe even London high up here. But we'll see how price action is playing out and showing us. When we let price action play out, as you can see, we would have ended up hitting 1 hour or trailing 1 hour. So that would have been a winning position. We would have got took out and this candle coming down here. But if you wanted to hold this position, you didn't want to go break even, you wanted to hold as you had a super strong draw higher, when you let price play out, as you can see, you would have caught the reversal from the bottom all the way back up to the London high in this example. As I've said, how I like to trade, I would have been took out with 1 hour here. You need to go and back test and journal and figure out, is that best for you? Do you want to hold higher? For me, I would highly recommend taking the 1 hour, especially on days like this where we should go hit the high but come back down. But find it out in your trading, and you're only going to get comfortable with that from going on the markets and finding it for yourself. But they are the reversal position we talked about. So now we've went over the two type of trade setups in this video. Continuation, reversal. It's very similar to external to internal liquidity. The continuation is a bit more different. We're looking for a pullback into that 50% range as we just talked about. In this example here, obviously it's external, so we're at the bottom of the range, trading back up into it in this example. We did go over two bullish examples. Bearish is just the exact same way, flipped to the downside, as you all know from the recaps and what I've done in the previous episodes. We're going to leave it there. That's continuations and reversals. The only trade setups you're going to use. Even when you use your AMD, it is going to sweep out some sort of internal liquidity or external liquidity. So AMD is just a setup, as we talked about in liquidity part 2. Continuation and reversal is the only trade you're going to be taking with this model to target TP levels and wait for sweeps on liquidity. We're going to leave it there, and I'll see you on the next video where we're actually going to be trade structuring loads of different trades. So you can then, at the end of the next episode, go onto the markets and start back testing and testing this strategy out for yourself in the live markets and in the back tested markets, where I'm going to show you how to back test and how to figure out how to actually find this model in your trading. We'll leave it there. Peace out, and I'll see you on the next video of the Curly Trading Blueprint. Peace out.